$56.12. That is the current stock price of Astec Industries. So the big question we're tackling today is this. Does that price tag hide a secret bargain in the industrial sector? Or are we looking at a massive value trap just waiting to spring on unsuspecting investors? Welcome to this explainer. I am absolutely thrilled you're here with us. Today, we're putting Astec Industries through the ultimate investor gauntlet. You know, we aren't just going to look at one isolated metric. We're dissecting this company using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some rigorous discounted cash flow modeling. By the end of this, we're going to know exactly what this company is actually worth. Okay, let's dive into this. Here's our roadmap for the analytical gauntlet the stock has to survive today. We'll start with a quick company snapshot, then view it through the Buffett lens, the Winch lens, and the Graham lens. After that, we'll test it out with our DCF and alternative valuations, and wrap it all up with our synthesis and final verdict. Section 1. Company Snapshot. The heavy metal. So what does Astec actually do? Well, they're a foundational player in the farm and heavy construction machinery landscape. They literally build massive, essential infrastructure machinery. We're talking equipment for asphalt road building, aggregate processing, concrete production, the whole shebang. This is heavy, cyclical, highly capital-intensive metal. And here's how that heavy metal translates to the balance sheet today. Astec sits at a market cap of $1.29 billion. They pull in a really solid $1.41 billion in top-line revenue, and they boast a gross margin of 26.5%. But here's the catch, and it's a big one. Their net profit margin is remarkably thin. We're talking just 2.8%. Let that sink in. That means for every single dollar of heavy machinery they sell, they keep fewer than 3 pennies in pure profit. That incredibly tight margin, yeah, that's going to be a recurring theme for us today. Moving on to Section 2, the Warren Buffett lens. As you probably know, Buffett looks for a few non-negotiable traits, so we built a scorecard based on his exact philosophy. First up, an economic moat. Astec does have specialized infrastructure products, giving them a narrow moat, so we'll give that a pass. What about manageable debt? Yep, with a debt-to-equity ratio of 0.56, they easily pass. But then we hit a wall. Earnings consistency is a hard fail. Their historical net income swings wildly. And return on equity? Buffett famously demands 15% or higher. Astec sits at a dismal 3.79%. For sure, that trips Buffett's alarm bells immediately. So let's summarize the Oracle of Omaha's verdict. Buffett demands absolute consistency and strong owner earnings. But when we actually look at Astec's track record, they posted $0 in net income in 2022 and lost $60 million back in 2018. Even more concerning, their current free cash flow is negative $29.51 million. You know, without predictable cash generation, you simply cannot calculate a reliable margin of safety, period. For Buffett, at the current price, this is a definitive pass. All right, Section 3, the Peter Lynch lens. Peter Lynch's first step is always to categorize the company. Based on our source data, Astec fits perfectly into his cyclical bucket. These are companies where sales and profits rise and fall in regular patterns tied to the broader economy. And honestly, that describes the heavy construction and infrastructure market to a T. The trick with cyclicals, according to Lynch, is all about timing. You want to buy them when earnings are at their absolute worst and the cycle is just starting to turn upward. Now, what's really interesting here is how Astec grades out on Lynch's specific metrics. Their PEG ratio, that's price to earnings relative to growth, is 1.07. That implies the stock is fairly valued right now. It's not exactly a screaming bargain. Their balance sheet shows moderate leverage of around 2 times EBITDA, which is acceptable, but it definitely poses some risk if there's an economic downturn. But check out the institutional ownership. Our sources note heavy ownership by massive giants like Vanguard and BlackRock. Lynch actually views that as a negative. He loves those under-the-radar stocks that Wall Street hasn't discovered yet. So an investor using the Lynch playbook would likely rate this a hold, just waiting for a severe cyclical bottom before buying in. Let's turn to Section 4, the Benjamin Graham lens. Benjamin Graham, the father of value investing, uses a strict defensive investor checklist. And Astec actually passes on adequate size with its $1.29 billion market cap. It also passes on financial condition with a really healthy current ratio of 2.34, meaning they can easily cover their short-term liabilities. Oh, and it pays a modest 0.98% dividend, so that gets a pass too. But it fails spectacularly on earnings stability because of those recent historical losses we talked about. And most glaringly, Graham requires a moderate price-to-earnings ratio. Astec's current PE is sky-high at 50.09. That absolutely disqualifies it for a strict Graham defensive investor. But we don't just stop at the checklist, do we? We run the numbers, and this brilliantly illustrates exactly what Graham's formula reveals about the stock. Using the classic Graham intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share, we can find the true floor. By deriving the EPS of $1.12 from their current PE and a book value of $29.53 from their price-to-book ratio, the math gives us a Graham intrinsic value of just $27.27 per share. So here's the absolutely crucial takeaway. The market right now is asking you to pay $56.12, but Benjamin Graham's math says the intrinsic value is only $27.27. That means there is absolutely zero margin of safety here. In fact, it's trading at more than double its Graham intrinsic value. Graham wouldn't touch this stock with a 10-foot pole without a massive, catastrophic price drop. Moving right along to Section 5, DCF and Alternative Valuations. A discounted cash flow, or DCF model, values a company based on the present value of its future cash flows. But you've got to see this sensitivity analysis. The 5-year base DCF value sits at a shocking, dismal $1.53 per share. You might be wondering, why on earth is it so low? Well, because you have to build a DCF off current free cash flow, and Astec's current free cash flow is severely negative, at minus $29.51 million. When your starting point is in a hole that deep, even if you assume a super optimistic weighted average cost of capital and 3% terminal growth, the math simply cannot generate a positive present value that comes anywhere remotely near the current stock price. So we have to look at alternative models to try and find some kind of silver lining. And here, we finally start to see why the market might be paying $56. While the earnings power value based on current margins yields a tiny $6.72, take a look at the forward PE of 14.17 and the enterprise value to EBITDA of 12.45. These forward-looking multiples suggest they are actually fairly valued relative to their industrial peers, if, and trust me, this is a massive if, they actually hit their future targets. You see, the market isn't pricing Astec on what it's doing today. The market is pricing in a huge operational turnaround, driven by their 2030 growth plan to finally improve those razor-thin margins. Finally, Section 6, Synthesis and Final Verdict. Let's summarize the breathtaking divergence we've found in our analysis today. Warren Buffett passes completely due to erratic earnings. Peter Lynch says it's a cyclical hold, basically wait for a downturn. Benjamin Graham's strict math spits out a $27.27 fair value, triggering a hard sell. Our quantitative DCF model completely breaks down at $1.53 because of those negative cash flows. Really, only the forward-looking EV to EBITDA multiples offer any defense, suggesting a value maybe in the $45 to $50 range, which, by the way, still falls well short of the current $56 market price. And that brings us to our final verdict. Based on the aggregate data from these legendary frameworks, Astec Industries at $56.12 is a clear sell or avoid. Look, for this price to make any sense at all, the company requires absolutely flawless execution of its 2030 growth plan to fix its thin margins and negative free cash flow. For the prudent investor seeking a real margin of safety, there is simply none to be found here today. The guru's criteria would likely only trigger a buy if the price collapsed well below that $27 gram threshold. I want to leave you with this final provocative thought. If the strict intrinsic math says a company is worth $27, but the collective psychology of the market is willingly paying $56, what is your personal margin of safety before you buy into a turnaround story? It's a question every focused learner needs to answer for their own portfolio. Thank you so much for joining me on this deep dive. Apply these lenses to the stocks you own, trust the structure, and keep learning.